Right now, for more on what's next with the U.S. China relationship, plus an exclusive look at China's fourth quarter GDP, let's welcome Leland Miller. He's the CEO of China Beige Book International. And Leland, it's great to see you.
Thanks for being here.
First of all, Eunice started talking about China's reaction to Iraq and Iran and what's happened there. My guess is China must be at least breathing a little bit of a sigh of relief that they are not number one on the president's attention, on his list right now.
Yeah, good things happen for China when they're not the focal point of Trump's anger. So this is a great thing. They've got a baby trade deal they're going to sign, and then now the whole world's worried about the Middle East again. So this is very well scripted from Beijing's point of view.
All right, let's talk about the fourth quarter GDP for China that you've been tracking very closely. How did it fare?
Well, we don't have an exact breakdown of how GDP is going to look, but we know the dynamics behind it. And I think that what we saw was actually a relatively smoother path in the fourth quarter than we thought. Manufacturing looked better, services looked better. But there's three really key developments that undermine our confidence going into 2020. And it's about future demand. New orders are falling. Credit is much more active than I think that people are talking about, than Beijing's admitting, because you're seeing much more credit going in for much less of a result. And then, of course, you're looking at a scenario in which a lot of these dynamics are not going to play into 2020 the same way they are now. A lot has gone into manufacturing, a lot has gone into services, a lot has gone into retail, and you're just not seeing the oomph from the policy support.
But you were surprised that the fourth quarter seemed to do as well as it did in China?
Yeah, but part of that was the comparison basis. When you're basing it off Q3, which is very weak in our data, and you're basing it off the fourth quarter of last year, which was extraordinarily weak in our data, you have a basic comparison that makes it look better than it actually is. So the main dynamic here is that things are not falling apart, and you may get a sentiment boost from the trade deal. But at the same time, you're not seeing any type of real expansion. Firms are not active right now, and you're not seeing that despite the fact that so much credit's going into the economy right now.
You think we've hit a trough, though?
Probably for right now. I think the beginning of the year is going to probably look better. That doesn't mean they're not going to report the GDP number is slightly less. So one of the things that they like to do is smooth it out, so they don't have to report big jumps and big falls. And that's one of the ways that they sort of smooth out the data. But I think that the course is clearer for the first few months of the year.
What should we be paying particular attention to over the next several months?
Credit is probably issue number one. That China right now, too, it has to make a big decision. So they have the Trump tariffs, at least the possibility of a huge escalation, mostly off the table right now. They have an economy that's smoothing out. Global economy is not looking too bad overall. And so they have to make a decision whether they're going to accept lower growth. And if they accept lower growth, and this is when they start the restructuring, this is when they start the reform, some of these structural changes. If so, then they'll allow slower growth, because for the first time in a couple years, the course is clear. And there's a policy decision to be made here on whether they're going to accept that slower growth going forward. We don't know yet.